welcome to Face. How's everyone doing? Everyone enjoying Face? Here's mine. Pandemic haircut. Okay, anyway, we have some interesting action today. It should not be, there you go. Thank you, Joe. That black screen leaves it all up to your imagination. I want a screen and I will paint it black. Aren't there a lot of great trades on Aren't there a lot of great trades on a black screen? Yeah. Stones, right, bro? Okay. So I want to welcome all our viewers on investing.com. I know you're equity focused. So why don't we start off with S&Ps, and then I'm going to take a look at some of the horsemen that have really been the major reason for this recovery in the S&Ps. So it looks like we have the potential of a double top here. I was a little surprised we didn't take out the high here and clean out stops, but this high was important because it did take out the stops from the April high. So, you know, we're still higher on the week, right? Because, you know, we were here last Friday. But this double top perhaps could generate some type of pullback. I'm not talking about a crash. Actually back to where the market turned good this week. And that was here over this 2860 level. In the coming days, perhaps we get a pullback before the next attempt for a rally. If you get that, give me a Y. Took some shorts a little early, double top. You know, if you took the double top, you have some money made. So for money management, you take half, you know, maybe you have 20 handles, 15 handles, and now protect yourself over the high. Worst case scenario is you make money. So very important when you have a lead. I'm a big believer in partials instead of being all in or being all out. So that's the way the S&Ps look to me. On a weekly basis, for it really to do something negative, I need a weekly close back under this week, 29.35 will give you a 2-week reversal. It's possible. 29.35, all we have to do is check this low here. So there's your look in the S&Ps. Also, besides this being at resistance, let's talk about a couple of the leaders that have gotten us there. I know that we're ForexAnalytix, but all of us look at everything. So Microsoft has been one of the leaders. And let's look at the daily charts on these. So we haven't made a new high. We're getting some divergences here. You know, if you were smart or lucky, not a bad place to take something off the table. I'm not saying we can't make a new high, but if we do, we won't confirm. And why can't we just have a little shallow pullback and pull back 15 bucks or so in Microsoft, right? And here's the other one. Here's Apple, even a little stronger. Okay, so here's Apple, not that far away from making new highs. We've had, you know, Facebook make a new high. So, you know, NASDAQ has really been the leadership. But again, you know, if you bought Apple well, even if we are going to make new highs, why can't Apple pull back to 280? I don't have any airline stocks open, and I have some other things. Look, you know, we have a whole crew, and you'll be able to ask your questions to the team that provide their analysis here every day, 24 hours, 6 days a week. Bitcoin's part of it. So we'll get that in a minute. Just a couple other things I want to cover. All right. Talk about the metals. So gold, you know, look at this. We do have a little reversal week in gold. We're about $4 lower on the week. I was thinking that we could test this breakout area. I have some confluence here at the breakout on the 2 hour. I have the moving average here. Looks like about 1713. Yeah, buy the next pullback. Don't chase anything here. So here's the gold. We'll see if we could, you know, start taking this out. I wouldn't want to see it starting to trade back over this high. I'm looking at this as being corrective, this being directional or impulsive, and we'll see if we can make it down here. What's going to be important down here is that, and I'm sure there's going to be some pretty good buying. Maybe we don't even get down here, but if we start closing back under 1714, then you could say that we have a breakout failure, and that's going to change the picture in gold for me. And, you know, not for a move to 1,000, but why not 1650? You know, go back to where we were before this big rally. Let's see. Yeah, back to here. 1650 is a possibility. Back to the bottom of the triangle line here. It looks like 1680 or so. That to me looks like a possibility. And actually, for the first day in a long time, silver is weaker than gold, and we've made new highs without confirming. Almost looks like it's a 1, a 2, and then we could get one more push in that. Everyone with me on it? And we are at that major test in euro, this 110 level. Okay, so I don't know, I'd be careful here on the euro, because look at this. This actually does look like a third drive. Here's your first. I was at first thinking this was it, but here's, call this 1. Guess you, and here's 2, and here's 3, and on the 1 hour chart, we're well under 70. There you go on the 2 hour, well under 70. So it could turn out to be some type of pullback. I'm bullish. Okay, if we get something like this, maybe a pullback to the breakout at 109, maybe just take it out and trade 870. This is where I'd like to buy. If we get a bounce in the dollar, this is where I'd want to buy the euro, and this is where I'd want to sell the Dixie back around 99.80 or so, maybe even up to par. Starting to get a little reversal here as well. There's hidden divergence. Okay, to me, it's not hidden, and I really don't know. Thank you, Jerry. But there is also unhidden divergence. I don't know how to find it. It hides too well from me. So I just look at the what's the opposite of hidden. Anyway, so that's what would you say, Stella?
Visible.
Obvious, visible. Yes. Okay. No, I like that. I just trade things I can see, not things that are hidden. Regular. Okay. And there's something else I wanted to talk about here. You know, this Euro Swiss call from last week is acting pretty good too. And maybe, like Joe Perry said, that a lot of brokers are raising their margins on Swiss. Maybe this had something to do with it. Okay. And this still looks good. And when I first started talking about it, I thought that we might have a shot for 108. And, you know, if you're long, you should have booked something, and now you have a profit stop under 50. Everyone with me on this one? Okay. I don't know what's going to happen if the euro pulls back. Euro pound has been a monster, and there were targets around 90.5 up here. We're starting to get some divergence in the oil market on some shorter term stuff here. Not confirming. Canada's still holding the triangle, but under 38.50 you have to be concerned. Here's a descending triangle. Well, to me, it looks like it's going to go. We held it here. We held it yesterday, and we're holding it here. Not much of a bounce off major support. Do you agree? And kind of a hope bounce that it's going to hold. I think we're going to break down out of this formation. And I think that's about it that I wanted to cover here. Oh, yeah, since you guys are stock people, maybe you don't trade the gold itself, but you know, a lot of people have piled into the miners. Here's Newmont. Newmont led the way, was making new highs before GDX. And look at this on the daily at new highs. Looks like there's some type of wedge developing here. And even though gold was up and silver was up yesterday, Newmont had a down day of about $1.66. So if the shares are leading on the upside, perhaps they're also going to lead in a correction. I'm not talking about a collapse, but perhaps you get a pullback in Newmont back down to 55 or so in the coming days or weeks. And that would be a much better entry than just chasing the miners after a huge move. So I wanted to show you guys Newmont. TLT takes a lot of patience. I mean, I've been in this trade for a long time. This too is hanging by a thread. You know, if we break down, I don't see why we can't see, you know, 152 or so for higher yields. Back over 170, we're going to get new highs. So you're looking to sell. You know, someone yesterday made a comment that RSI is not a predictor of price. I agree 100%. But there's a reason I named it the real simple implicator, because it can tell you about future direction when, let's say, for example, let's go back to gold, that when price, see this RSI here, all the way back here, and see the RSI, like 85 here after gold got going. So this is a predictor of price because it's a confirmed high, and markets rarely peak or bottom when momentum is confirming that move. So as a trader and having that knowledge that it's a confirmed high, the implications is it's just a high, not the high. You don't start looking for the high until we start making new highs that aren't confirming, like what's happening now. But as a trader, when I have a confirmed high, I'm saying to myself, well, it's a good chance that's not going to be the high. So as a trader, I have to look to buy a pullback knowing that there most likely will be another high like there was that may or may not confirm. Okay, this did not confirm and eventually led to this. So you can use the RSI for more than turning points. You could use it as a trend trader. And as a trend trader, when you have confirmed price action, new highs, new lows confirmed by momentum, that momentum on highs is making a new high, on new lows making a new low, it gives you some pretty important information that it's just a temporary higher low. And as a trader, you use your other tools for looking for entries to go with that, knowing that another higher low is coming. So you guys ever think about that, to use RSI that way? Okay, so you don't just use it for overbought, oversold. Okay. We don't answer questions in caps. Okay. So, great day to join ForexAnalytix, don't you think? Anyone join this week? Let me ask you this, Joe is here. Anyone interested in, well, welcome to our family, Xavier. Anyone interested in a 6-month or annual deal and working something out with Joe for maybe a little better price? Joe, will you put out your email? We're not going to do anything on a monthly basis, but 6 months or a year, perhaps Joe can work with you. Joe Perry, come up with a good price for you today. Today only, or the next time I mention it. Okay? So Blake, good morning, buddy. How are you?
Hey, good morning, Dale. How are you?
Good. What you up to?
I am trying to figure out what to do this morning. I just took my euro pound off long that I've been long this here, let me grab the screen really quick. I've been long for the last like couple weeks and it's actually been one of my more longer term trades. Can you see my screen?
It's coming up. Yeah.
Okay. So let me go over to the euro pound. So we just hit the 38% retracement. And even though I'm still expecting a range extension to take us towards, 90, 90 and a half, somewhere around there, I'm a little worried that intraday, you can see the, rally is continuing, relative strength is divergent. So I'm more interested in buying a dip now versus, and because I think that, we might have seen the highs near term. So for me, I'm just looking for a dip to buy into. So, now that we're up here near the 90 pence level, I think it's, it's a little bit, you got to be a little careful with near term longs in the euro sterling. Does that make me a pound bull or a pound bull? Not necessarily, but if you look at the euro dollar, we're up at 110. We're at 110 and the euro dollar continues to rally and push up towards 110. Relative strength is divergent. So kind of like the euro sterling, I'm a little, concerned that the euro bullishness, we might pull back a little bit here at these levels. I really want to be long overall. I really want to be long the euro, but I have to buy a pullback. I'm not interested in buying it up at these levels at this stage in the game. So that's kind of what I'm thinking. And equities are down. The equity markets are down a little bit this morning, but I'm not necessarily bearish up here. I am concerned that we might have some pushback from the hold on really quick. Sorry guys, let me just do something really fast. I was thinking we might have some pushback from China here over the weekend. So I'd be a little careful with the S&P up here. That the Congress voting on the regulations, stricter regulations for these Chinese companies, I think is going to be a risk for the equity markets. We talked, well, we didn't really talk about it yesterday, but the push to really delist some of these Chinese companies from the U.S. exchanges, I think is going to be a big blow to the U.S.-China relations moving forward. And, that once that gets signed into law, you're going to see a lot of these companies at risk of being delisted, like the Alibabas of the world. And if you look at like FXI, which is the Chinese ETF, we're struggling here at resistance. So, we're just above like this 50% retracement, but you can see this is a lot of high traffic area, for the FXI. And this is, if you guys are bearish on the U.S.-China relationship, this is probably the short right here. Just I know there's a lot of people from investing.com that actually follow equities. This might be one that you want to, as long as it's below 40. I think it's more of a bearish possible reversal up here. But yeah, you look at stocks like Baba, got hit yesterday pretty hard. It bounced going into the end of the day, probably because China is going to wait to
Retaliate?
probably, what's that?
What kind of retaliation do you think could happen from this?
I don't know. I'm not
Yeah.
really 100% sure, but I think the risk of the risk of China ramping up rhetoric on treasury purchases or something.
Yeah, there you go. That could be one.
Yeah, I think that's actually a risk for equities, and I'm not sure what they could do. They're going to pour a lot of money into their technology development. They announced that yesterday, but to take on some of our companies. But I think it's going to just intensify the the deteriorating U.S.-China relationship that we've got. And somebody had commented me on Twitter about Donald Trump not wanting to to disturb this or whatever. But the fact of the matter is, in Donald Trump's eyes, this virus, the COVID-19, is really putting at risk his reelection bid right now. And so he's trying to find anything to however he can rile his base. And I think one of the ways he can rile his base is heating up the China talk.
China.
Yeah, like who's going to be tougher on China, me or Biden? I think is what his approach is going to be going into this fall. So I expect things to worsen. And if you think about where stocks are at right now, the equity markets have recovered quite a bit. And I think that Donald Trump probably looks at, hey, where we're at is fine as far as equities go. And yeah, even if we come off another 10 or 15%, from current levels, it's much better than we were at the heat of the virus. So I wouldn't be surprised if this rhetoric picks up. And that is a risk, I think, for equities. And it's a risk for like the Aussie dollar. And so the Aussie, we are getting close to pretty key resistance. I've been wanting to sell the Aussie dollar up here at the 200-day moving average, the 60 to 67 cent level. I'm hoping we reach for it. What I will be looking for, in case this happens, is a little bit of a reversal here in the Aussie back below. If we start breaking back below like 65 cents, like down at these levels down here, I'll draw it out for you, somewhere down here, then I'm gonna be more bearish on risk than I am at this moment. I mean, equities are in all actuality still holding up pretty well. What else am I really looking at here? So I've been closely watching this dollar Canadian, and the dollar Canadian, I think we have this wedge pattern. We're near support, but at the same time, we're not breaking this 138.50, and I think we've got to keep an eye on the dollar Canadian because crude oil's had a nice bounce, and if crude starts to roll over a little bit, the dollar Canadian, a break above this, well, we can just call it like the 139.40 level, somewhere around here. Somewhere above that resistance, I think, takes us back towards the upper end of this wedge, which is near 141. But I'm watching this dollar Canadian because it's not breaking down, and if it doesn't break down, then the risk is starting to increase that we're just going to break higher. So I think we got to keep an eye on the on the dollar Canadian. It's a pair that has held up extremely well. And like I said, if risk aversion starts to pick up a little bit, I think the dollar Canadian's at risk of moving higher from here. So it's something that I'm just trying to, pay pretty close attention to at this moment. Man, this euro is strong. Surprised the euro is as strong as it is right now. I do want to buy it on dips. I just trying to find a dip to buy this thing is it's not doing it. It's not doing it. It's my patience is starting to wear thin. So, waiting for this. But anyway, that's kind of what I'm looking at this morning. I'm not too active here because I'm just trying to find, a good trade setup for now. One of the other things I do want to mention before Steve and Stelios come on, the dollar Mexican peso. This is a pretty big breakdown. I was hoping that we'd get a rally towards 23.40 back up towards this resistance so I could sell into. I just don't know if that's going to happen. The dollar Mexican peso is trading a little heavy down here, so we'll see. So Steve, Stelios, good morning, guys.
Good morning, Blake. Good morning, everybody.
How are you guys doing?
Very well, thank you. Very good.
Good.
Waiting for these unemployment numbers in 3 minutes, so waiting for that to see how.
Yeah, we got
and Philly Fed.
What?
And we also have Philly Fed.
And Philly Fed, yes. So we have some employment data, Philly Fed, dollar yen. Nothing exciting came out of the BOJ overnight, and so we're just kind of trapped here below this 38% retracement around the 108.20. So yeah, we'll watch the weekly unemployment claims. You guys have your eyes on anything in particular?
Not really. I mean, it's a holiday on Monday, right, for the US and the UK. So tomorrow is going to be probably pretty dead because it's going to be a half day in the US. So I think today is going to be whatever move we see today, I think is probably going to continue into tomorrow and over the weekend. But I'm not really looking at anything in particular right now. It's obviously equities is the main thing yet again driving everything.
Yeah, and I'll just reiterate what you said. Monday is a holiday here in the U.S. It's Memorial Day, so we are not going to be broadcasting on Monday morning for the FACE webinar. Just letting you guys know, but normal operations will resume on Tuesday. And yeah, we got weekly unemployment claims. So I'm going to pass it over to you guys, to Steve and Stelios, and so.
Okay, mate.
Pass it over to you.
We're here.
Good luck.
We're going to cover
Good
the
luck,
data.
everybody. Hey, I'll see you on the Daily Roundup webinar in a little while. So I'll see you in about 4 hours on the Daily Roundup webinars for the ForexAnalytix team.
Absolutely, mate. Bye-bye. Hey, Dale. Stel.
Hey, guys. How you doing? Good?
Good.
Yes.
How have you been?
Very good, very good.
So we have another 2.5 million
oh yeah, 2.5 million
jobs
expected
to be lost this week.
We're getting close to 40 million over the last 2 months or so.
Yeah, which is amazing. Yeah, it is out of this world. This, this bloodbath in the labor market.
But they're all going to be hired back within a month or two, right?
Of course. Within a minute.
Okay.
So what else did we have before we get the data?
Sure. We had some data today, this morning, PMIs out of Europe, services and manufacturing. They were mostly in the high 20s and 30s, roughly in line with expectations. The UK actually was a little bit better than expectations, but really they're painting a pretty horrible picture. And remember, these now are numbers for May. So we're in full lockdown, and we should be seeing theoretically the bottom and all these numbers slowly coming back. Also remember, actually, no, we're going to talk about that after the numbers. We have about 10 seconds. But yeah, overall, the numbers were in line or maybe slightly better than expected, but I'm going to elaborate a little bit more after the numbers. So let's wait for that.
Let's see what we get. Philly Fed expected minus 41.5. Previous one was 56.6. Obviously, we're going to start, seeing.
2.438. So in
as
line,
expected,
basically.
2.5 million jobs, another 2.5 million jobs lost. Previous number was revised lower to 2.7 million lost, and we're still waiting on the fully fed.
Yes.
Lately,
Okay.
a lot of data prints are a little bit delayed. I don't know why that's the case.
Yeah.
Okay, so
Yes.
I assume we're going to get that as well within a few minutes,
Yes.
a few seconds to a few minutes.
Few minutes. Okay. The other thing I want to say, we're talking about PMIs. Remember, these are. This is a number that goes from 0 to 100. Shows if it's contracting or expanding. If this number, we're seeing 20s and 30s. If this number goes back to 50, it doesn't mean that we're back to where we were. It just means that it didn't contract.
It means
expand.
that we stopped contracting. Yeah,
yes,
there it is.
Exactly.
Fully fed just came out, minus 43.1 versus minus 41.5.
Yes. Yeah. So roughly, actually, pretty good estimates. Given the range of these numbers, I'm actually quite impressed.
Indeed.
So that's what I want to say about PMIs. So we're seeing pretty bad numbers, but theoretically we should start slowly going back towards the 50s, which means that the bottom is in. Obviously, this is not a given, but that's theoretically how it should go. Otherwise, it's been, what else is it to say? We didn't have any developments regarding the coronavirus, nothing in terms of China and the US. The American side are still throwing some punches towards the Chinese, and we're all expecting the retaliation or some kind of reaction from the Chinese. It's definitely not bullish in my opinion, but the markets clearly don't think so. Having performed pretty well this week so far, equities. I mean, even though they're down a little bit today, overall the S&Ps are like up 100 points this week. So, you would have thought that things are going great everywhere if you looked at equities. But yeah, other than that, it's been pretty quiet. I think nothing more to say. We didn't really have any other any developments, so I don't know what else to say.
Okay, still okay. Then we can jump straight to the charts. By the way, I showed this on the daily roundup yesterday, and I think it's a good idea, sharing it here. Still, you remember we showed a few days ago the forward estimates for the S&P. Just look at this from the Russell. Look at the forward PE.
Yeah.
First of all, the Russells, and that's important because it's another indication of what we were saying, that coronavirus was a huge hit to the economy, but the economy was in trouble way before that. Testament to that, we know that the Russell has companies that do business in the US, so it's a better gauge to the health of the US economy specifically. The Russell's earning estimates peaked at the very beginning of 2018, and look at the tumble following the coronavirus. We went from just below 70 to $30, which has actually produced this vertical rebound in forward PE to more than 40.
Yeah, and this is what you were saying yesterday and the day before yesterday. Valuations are pretty much almost at all-time highs.
I'm pretty sure that for the Russell, this is an all-time high by
even
far.
Though the actual index itself is not at all-time highs, as forward estimates do drop, then valuation is gonna rise. It's only mathematics. So some people fail to grasp that, but it looks pretty horrible, I have to say.
Yeah, it is. It is quite scary, actually. Okay, so that's just to get an idea of where we currently stand. Having said that, we've closed above the triangle in the S&P. We have satisfied the minimum requirement, which is producing a higher high even incrementally. I still believe that this confluence of resistances might act as a magnet at around 3010. I wouldn't even rule out and move all the way to the 78.6 at 31.37. I find it quite hard to get there before we see a deeper pullback. So I'm still looking for a deeper pullback, sooner rather than later. Keep in mind that the Nasdaq also found resistance yesterday at this ascending wedges trendline resistance. It has retraced almost all of its recent losses. So I do think that the next move is going to be to the downside. I don't think we have much more to the upside before we at least before we see a deeper correction. Now, having to do with FX, the Euro USD is testing once again this key confluence of resistances, the 200 daily moving average and horizontal resistance area at 110. Obviously, if you want to be doing something with it right here, right now, it only makes sense to be short. Not because I'm bearish the Euro USD, but simply because we're on top of a key resistance. So from a risk reward perspective, if you really want to do something here, it is to assume that the same resistance area might reject price action once again. Now, on the other hand, if we do slice through this, that's going to be a bullish development. This is going to be breaking to territory that we haven't seen in a month, and most importantly, triggering this rectangles range, which would point higher. 111.50 is going to be the next upside resistance area. At the same time, the DXY, which is inversely correlated to the Euro USD, quite strongly. Not exactly a rectangle, more of a triangle here, but you can clearly see that more or less we have the same type of situation. So same deal here, very close to support at the moment, which means that you either wait for a breakdown to trade it, or you might want to fade this weakness, believing that the same area of support is going to once again hold price here and see a rebound. Now, the cable, nothing has really changed since yesterday or the day before, meaning there is still a chance that this is a head and shoulders formation. We broke through it. We've rebounded to backtest twice, yesterday and the day before. The confluence of the broken neckline and the 200 daily moving average. So bottom line, it is bearish as long as it trades below 123. If we trade back above 123, then once again the technical formation becomes a lot more obscure. I mean, we're going to have to give it more time to determine what's happening. But from current levels, the risk reward definitely favors short positions, because you can risk very little, and if this head and shoulders formation indeed plays out and the neckline rejects price once again, we might see the next move fulfill the formations target, which is at 118.20, also confluencing with the 61.8 of that last move higher. So it's a nice target area any way you look at it. Now let me go through some of the questions. What do you think of Tesla? Okay. We don't usually cover stocks, but I'm going to tell you what I think of Tesla. I think that regardless of the future of the company, which I'm very skeptical about, I have to tell you, I think that current valuation is ridiculous. I mean, Tesla is a bubble. I think that the likeliest scenario for Tesla going forward is that at some point it's going to lose big part of its value and probably be bought off by one of the bigger companies. I think that Tesla lost its chance of really being competitive when it wasted a lot of time. It was the first one that went back into electrical vehicles. I mean, serious effort back into electrical vehicles but it gave a lot of time to the big companies to develop competition of higher quality, and Tesla still has huge issues having to do with quality and production. So I'm not at all optimistic about the future of Tesla, but if it has proven one thing, is that it has, you know, a very cult type following, and a lot of its investors are still throwing, in my opinion, good money after bad money, and current valuations are just out of this world. I mean, Tesla is at some point, at this point, has something like 3 times the capitalization of BMW, which I have no words about it. So it is a bubble, and bubbles can go higher, right? Because there's no prediction, there's no price prediction you can make about a bubble. You can only predict that at some point it's going to deflate and implode. But before it deflates and implodes, you know, there is no real way to put a ceiling there. So, you know, it's very dangerous trying to be short Tesla just because of what I described. From a fundamental perspective, I think that if it was trading at 1/4 of what it is trading at the moment, it would be very rich. It would still be a high assigned valuation. That's what I think about Tesla. Steve, hi, can you cover the Aussie and the Kiwi? Yeah, absolutely. We're going to do that. Actually, let's do it now. So here's the Aussie, which, you know, unsurprisingly, it follows exactly the pattern that the S&P has followed the upside. As you see, at the same time that the S&P was, you know, poking its head above the triangle, the Aussie USD was doing the same. So I do believe that it's going to share the same fate, meaning I do think that it's probably going to fail rather soon. 66.60 to 67 cents, roughly there, is a nice cluster of resistances. So I would be very, very careful at these levels. I think that, you know, the risk reward is going to be extremely favorable for short positions. Now, I'm not saying that after it gets rejected, it's going to move all the way to new lows. It might happen, but there's a good chance that it won't. I'm saying that at least it's going to have a deep pullback. And, you know, when that happens, we can, you know, put it under the microscope, examine what type of price action we get, and determine if, you know, it's going to be a corrective pullback, in which case we should, you know, start looking for levels to be buying it, or if it's going to, you know, to continue the longer term downtrend. Because don't forget that the Aussie, I mean, you know, you should always have the big picture in mind, and this is the big picture. The Aussie USD has been producing lower lows since August of July 2011. So, you know, keep the big picture in mind, right? And we still have not produced a higher high. I mean, this is still, if we fail anywhere from 67 cents, that's still going to be a lower high. Now, the Kiwi was significantly weaker than the Aussie for a period of time. Aussie Kiwi was clearly showing, you know, that. Has had a nice recovery during the past 4 days. I think more or less, you know, they're going to share the same fate. I think that the Kiwi might end up producing a higher high as well, or it might diverge. I mean, we've already seen the Aussie produce a higher high and the Kiwi hasn't. So these type of divergences can you know, help you time reversals very frequently. So for example, if we see them rolling over without the Kiwi having produced a higher high, the previous high was here at 61.76. We're below that at the moment. But even if it does produce a higher high, I assume it's not going to be easy for it to go above the 61.8 at 62.60. A little bit higher, we even have the, at 63.20, we have the 200 daily moving average. I doubt it's going to manage to go above that. So I'm expecting a failure from there as well. And the rest is exactly what I mentioned about the Aussie. I mean, might be a corrective pullback back, for example, in the case of Kiwi, at least back towards 59 cents. But, you know, most importantly, we should examine what type of price action we get once they start depreciating, so we can actually determine if that was if this low, for example, here at 55 cents was, an important low from the market, or just a short-term low. But for the time being, as I said, I think that they both will fail, within the next few days, weeks at most. We're going to have to start by seeing a daily reversal, and we take it from there. For the time being, no need to try to fade them unless your trading style is to start building a position because you have high conviction. That's absolutely fine. Otherwise, if you don't want to front run that, you should wait for a daily reversal. That's for a daily candlestick, in essence, that's a good reversal indication, and then try your luck from there. Anyhow, we're here every day, so we're going to keep monitoring, and trust me, I'm going to let you know once I see something that's worth noting. What do you think about Facebook and Amazon following the announcement that Facebook are planning to compete? Listen, the market considers these stocks to be safe haven stocks. I think that's going to prove to be a huge mistake. I think that they're extremely overpriced. I'm not saying that they're not good businesses, right? They are good businesses, both of them. And they definitely have good products. But I do think that at some point people will realize that the few names that have survived the massacre are not really safe havens, and I think they're going to suffer greatly. Now, alternatively, let me say it like that. What do you want me to tell you? To buy them? I mean, they can definitely go higher, but this is lunacy. I mean, these valuations are just ridiculous. Pay attention to, if you want to be more specific, pay attention to the RSI divergences. Just look at the daily RSI here in Amazon. I mean, it's been diverging since that high. So it's been diverging since we were at 2185. We've actually posted a higher high, another higher high, another higher high, and for each of these instances, the RSI is lower. Pay also close attention to the fact that we have a nice cluster of resistances, 2510, 2530, both of them 161.8% extensions, one from this pullback and the other one from that pullback. So I would be very, very careful here. I think they're very overdone in the short term. And at the very least, I would expect something like, at the very least, I would expect something like that. Even if they continue higher, I would expect at least a retest of this previous high at 2185, for example, in the case of the Amazon stock. Okay, having to do with Facebook, currently at all-time highs once again. Same deal with what I said before. I mean, I think that it's going to at least produce a deep pullback at some point. I would at least expect it to fill this gap here that it was left at just below 194. There is no way that somebody can excuse chasing these stocks up here with current looming risks and with the stock market pricing in more than rainbows and unicorns. Any disappointment in the path of recovery, which is just stupid. I mean, what is priced in is stupid. Any even short-term realization from the market that the economy, you can flip a switch and turn off the economy, but an economy can never turn back on like a light just by flipping up a switch again, because think of it like a tanker, right? I mean, in order for it to turn, it needs a lot of time, and it needs a lot of effort. So an economy is like very fast in shutting down, but it's extremely slow in turning on back again. Question about the IBEX, sure. Let me find it. There it is. So here's the IBEX, here's the price action. Listen, first of all, just look at the big picture here, right? Huge corrective formation, a huge multi-year triangle. We broke through it in an impulsive manner, and we seem to have created a pennant. You know, I assumed we were breaking lower, and that might still be the case, and we might see lower lows. There is an alternative interpretation here, which is also bearish, let me say in advance, but it's not so bearish in the very short term. So an alternative interpretation would be something like this. But in any case, I think that there is a lot more pain to come for the IBEX. So these are the two likely outcomes. But in any case, I think the IBEX is to suffer more. Same with Italian stocks. I mean, it's the same deal. JPY INR, oh my God. Let's have a look at the opposite, INR JPY. Anyhow, it's the same thing. There you go. You can clearly see here series of corrective moves, right? And until proven otherwise, the path of least resistance remains lower. Right. Now, you know, pay a little bit attention to this one. I mean, you know, we might see a big recovery. You know, the formation might be something like this in this case. We're going to soon find out. So, you know, pay a little bit attention to this to see which of the two is going to play out. But in any case, I think that, you know, the INR remains quite weak against the yen. And, you know, we're still extremely far away from being able to determine anything really bullish on this chart. You know, so for the time being, you know, keep looking lower. Question about the Nifty. Here it is. There you go. No. Impulsive move lower, corrective rebound. We've found support in this support area, but we need to do a lot more to prove that this can move higher. It can perhaps alternatively do something like this. So, you know, if we do cross above like 9.7K, I would be looking towards 10.5K. But in both cases, I would be looking for a continuation lower following that. So, you know, what's 8,770 as an area of support? If we bridge through it, I think we're headed at least towards 7,900 again. So, no, not looking good. Pound Swiss. Okay, so speaking of the Swiss, I mentioned the other day that something seems to be happening in this market, and you can clearly see it here. We clearly got the invisible hand of the S&P deciding that they want to hold the 105 area. They've admitted that they're intervening in the Forex market to support it, so there's no question about it. They have not, I mean, they've decided to stay away, to veer away from what they did in the past in imposing a rigid floor, as they had done with 120, because then they know that the market can test and, in essence, you know, break that after a point. But in my opinion, it's more than clear that they've set, without explicitly announcing it, a floor at 105, meaning as long as we are close to 105, now that we've broken through this descending channel, I think that there is a good argument to be made why somebody would want to look higher here. And in essence, look lower in the Swissy. Now, keep in mind that once we get risk-off conditions prevailing once again, it's very easy for the Swissy to, to pull back to the 105 area. But in my opinion, it looks quite clear that the S&P will defend this level, as strongly as they can. So, whenever we get close to it, Euro Swiss at least is a very good proposition to the upside. So having said that, as an introduction, now, if you want to have a look at the pound Swiss, which is here, there it is. So here's the pound Swiss. Let's adjust this chart a little bit. Found resistance at the confluence, you can see, of the 50% fib and this horizontal support resistance area. So that's quite significant. Below that level, and especially as long as the pound is, under pressure, it can continue lower. But so far, the pullback is not necessarily impulsive, meaning, I can see a good argument of why this is simply a corrective pullback. So, I wouldn't rule out to see a move like that. And if you do see that and you eventually see a break above 122.12, I think that's going to be, a nice buying opportunity, because the next real area of resistance is quite a lot higher at, at 21.2840 or whatever. So that's what I think about the pound Swiss. But in general, I'm not very fond of trading, this type of crosses. I'd rather put my money elsewhere. That there is, the market is a lot more free to do stuff, and that's why it's easier to to predict what it should do. Next is stock to buy for swing trader in US markets. What do you think of Tesla? I'm trying to find. Hello all. Can you look at airline stocks, American Airlines and such? I think they're in big trouble. This is why I'm asking if Lufthansa closes in on a 10 billion state rescue deal. Yeah, they're going to get rescued. They shouldn't be. They definitely shouldn't be. They should let them go bankrupt. A lot of people don't understand that going bankrupt doesn't mean that we're going to be left without airline companies or whatever type of company. It just means that the company is going to go through bankruptcy, and there's going to be a new management coming through, buying the company and its assets for a much lower price. And hopefully it's going to be a management that's going to be much better in managing tough situations than the previous one. For example, we've said that before, US airline companies spent something like 96% of their free cash flow during the past 10 years to buy back their stocks at ridiculous valuations. And guess what? The first sneeze, coronavirus obviously was not a sneeze for the airline companies. It was like a disease. But no matter what happened, even a sneeze, they had nothing left on the side. And they had nothing left on the side because they kept spending their money in, window dressing the stock price so management could, make bigger bonuses. And that's absolutely fine if you ask me, maybe because I'm a capitalist, but it should be fine as long as if you take that decision, you should also be willing to go bankrupt. Because if you take a risk and the risk doesn't pan out, then you should be punished for that. That's what the free market does. The problem is that, these companies know that governments are going to run to the rescue, which they shouldn't, because that then creates this moral hazard. For example, in my opinion, the reckless way with which they were acting with their money is a product of what we have done in 2000 and 2008. So they really believed that, okay, who cares? No matter what happens, we're going to knock the door of the government and the taxpayer is going to bail us out, and we can keep on doing what we're doing. So this is the huge problem with moral hazard, that in essence it penalizes prudent behavior and it rewards, the most reckless type of behavior. And imagine, there are companies that were actually not doing that. They were putting money on the side in case of something went wrong. Imagine how the administration of these companies feels. They must really feel they're stupid, right? I mean, they're seeing every sector that was reckless enough and didn't have a penny on the side to go through a tough situation, getting bailed out, and they don't need bailout money because they were, prudent enough to know and act like they know that an economy has good days. It has the part of the business cycle that we are in expansion, and it has the part of the business cycle that something wrong will happen, and they go in contraction, and they have a fund for a rainy day, and now they feel stupid. They're like, oh my God, we could have also bought back our own stock, made headlines, and go in essence bankrupt without going bankrupt because they're going to rescue us. So many of these companies that acted in the way they should, next time we're going to have a crisis, they're going to be, next time we're going to be in expansion, they're going to be like, why should I make a rainy day fund? I mean, no matter what happens next time, I'm just going to, knock the door of the government and ask for a bailout, as I should have done the previous time. So next time we're in trouble, there are going to be even more companies that are going to be needing, a bailout than in this case.
We don't need one.
No, we don't need one. Steve, when central banks print money out of thin air, does that money have to be paid back? I ask this because it seems shocking that the S&P could defend the 120 floor with the ability to just print money. Thoughts? Yeah, we have a guest. Just in 2 sentences. Listen, there are people that believe in something that we've tested multiple times in the past and we know the answer to. It means there are people that believe that you can print money out of thin air and nobody has to pay for it. We know better than that historically. So, there are 2 ways to pay for money. One of them is through taxes, which is bad, but at least it's honest. I mean, they tell you upright that, this is how much money we need. We have to take it from your pocket, from what you earn. And there is the dishonest way of taxing people through inflation. Now they're following the latter. It's gonna, the chickens are gonna come back home to roost. Not yet, because the initial reaction to the crisis is gonna be deflationary. I don't mean that we're gonna go in deflation. I mean disinflationary, let's say. But I think that following that, all that is gonna come back, and there isn't a more expensive tax that you can pay than inflation. It's going to prove a lot more expensive than just taxing people. Thanks, Coach. Who do we have today?
Matt Thistle, excellent technician, and I went to Home Depot. I know I won't need it right away, but I bought my wheelbarrow for when I can't carry all the cash that I'm going to need to go buy.
Be very careful because be very careful because there are true stories that in Weimar Republic people were taking their wheelbarrow full of money so they can buy stuff, and they couldn't carry it inside because there were steps, and they went out of the shop and they found all the money thrown down on the street, but they had actually stolen the wheelbarrow. Because
that's why I'm getting long wheelbarrows.
Yeah.
All right, man. I know the story. I was there in a past life during the Weimar Republic. So anyway, Steve, great job again. Some great action in the markets today. So anyway, I'm bringing Matt on, and everyone take a look at your 2-hour Euro USD chart. And if you want to know what a 3 drive to a top, at least temporarily, looks like, take a picture. Matt, my trading warrior brother, great to have you back here, especially with everything that's been going on since you and I last talked. So let me I'm unmuting you. Hello, Matt.
Yeah,
welcome
hi.
back to Phase.
Hi, thanks for having me. So I hit share here.
Yeah.
And so let's move this little bar.
So, Matt, I'm trading a little better than I did in the last pandemic.
Okay. What's that for you? 1968? No, just joking.
Yeah, you know, I mean,
You and your
my first go around, yeah, when I was hanging out with Jesse Livermore, we were just in high school and we weren't
there we go.
in stocks yet. But anyway, welcome
Well,
back, buddy.
Good,
Lot
thanks.
to talk about, huh?
Exactly, yeah. And thanks for mentioning Livermore. We'll, of course, make our way to him as usual.
Yeah, I always look forward to talking to you, and you know, everyone, you could follow Matt on Twitter at DJ Thistle01, right?
You betcha.
Okay.
Cool. Yeah, so let me just grab my notes here. And yeah, so as I was preparing for the last show, or for this show, taking a listen at our last one and kind of realized that over the, I don't know, year and a bit that you've had me on regularly, I've been kind of telling the same kind of story. And that this story has to do with cycles. Solar cycles was one thing we were talking about from this sort of GAN cycle side of things, and then you know, just a typical recession from just the credit cycle, and also if we were to look at the long-term versions of
you know, since you brought up GAN, someone sent me a GAN wheel chart that shows something huge happening in late May that has something to do with some type of square from 1929.
Interesting. Yeah, because of more of a crypto person, I've not taken advantage, you know, done the GAN squares and wheels and all that kind of stuff as much as I personally just focus on like the cyclical action within a sector, you know, cycles within cycles, because time, you know, there's definitely elements of time, but yeah.
Well, the guy actually sells a wheel. I didn't buy one because I asked him, I said, if I have a flat on the I-10, can I use the GAN wheel for a spare? And it doesn't seem to work that way. So
probably not.
I passed on it. So okay, I'm gonna stop jabbering.
Okay.
And why don't you tell us? Go ahead. I'm gonna be a listener now.
Sure. So in the last interview, things in the economy were starting to roll over, and you know, like my general market, you know, belief is that markets are fairly correlated, and that's because of risk and liquidity. And you know, I use a little bit of astrology for my cycles timing, and then you know, general TA to make those cycles and projections kind of fit within typical, you know, technical analysis market cycles and market structures. And a lot of what I've been looking for the past year is some type of what I call a 1987 style event. And what I mean by that is not that it's definitely like one big large crash in one day or a couple days and things kind of recover, but systemic risk that is a lot of panic, and that structurally on the chart we will see, you know, things staircase up, a big waterfall down, and then things slowly recover. Now, what I was talking about in the last interview was that we've seen what the coronavirus was doing in other countries, and I was saying that, okay, it seems like our plan in North America is to just sort of mitigate spread as much as possible. It's not stopping it. And through that, we have definitely seen a huge, you know, staircase up over the last couple of years, and then this huge waterfall down. And also what was in the last interview is me saying that I think, you know, the Fed is just going to, you know, print a whole bunch of money and pump liquidity into the system to keep that panic at bay. And that pretty much has been what all they've been doing, right? Is just printing money. And I think I recorded a quick clip from the last episode, so it was easy to find. So this is you talking and then me answering, and then I'm just going to read.
Figures.
Yeah, and then I'll show you some charts.
Okay.
So we were talking about gold and silver.
Yeah, I don't think we could hear it on Zoom. You can hear it, but I don't think we can. Can you hear me, Matt? We can't.
Oh, yeah, there we go. Now I'm going to close that. So
yeah, I think it's Zoom. They don't allow you to play, or there's a special setting for that. Anyway,
okay. So to recap, what it was,
I attest to you talking about
it.
Yeah.
So what we were talking about here, and so the interview was on the 11th or the 12th, and what I was talking about was the systemic risk and the correlation of the risk once, shit hits the fan, so to speak. And that is exactly what happened, is that as, the Dow or the markets rolled off, I said in my little spiel there that people may or may not have heard, was that I would think that if the markets roll over in an event, the Bitcoin would, and it didn't. And I said gold would, and as you can see from the huge, cascade during the panic, gold did as well. And even Amazon, which is good now and at new highs, also took a huge hit. You see gold, Bitcoin.
It's binary. Everything's binary, man. Everything's going up together and down together.
And all these three things also turned slightly ahead of the market. So what I was saying in that blurb was a 1987 style event. We were looking at that on like solar cycles and flu cycles, and we have 11-year cycles on those, and those were matching up. And I even said, this was in the charts we're showing in January, I was saying a 1987 style event in 2020. And that is certainly what we've got. And then for people that maybe, newer traders or whatever, what happens is as the market is rolling over and dumping and everyone is selling, things that might still be profitable for them, like Bitcoin or gold that they're in, sell off as well, because people need to make up for their losses in the general market. So even Amazon, where people might have been in profit, and because of the online ordering, still ends up doing better than the market, it's still sold down as well too, because when everything hits the fan, people need to take their good money to pay for their bad calls. So that's just something that, yes, people really need to understand, that there's really not much of a hedge in ultimate panic. So you kind of...
Even the bonds, Matt.
Yeah, you got to buy your hedge during the end of the panic, ironically enough, right?
Yeah. Even the bond suffered from 180 to 140 from the low. So, I mean, that was after the panic. But, where could you have hidden cash, right?
That's about it, right? And, not every single person is going to be able to fly into cash in and out, but just the point is, we have risk, and you have to understand the general macro environment. And that was something that, personally, as a trader, I was very happy with all this analysis, because it was a pretty detailed viewpoint of multiple sectors and how things are working together. And these are the wins that, sometimes as traders, we really take it in the chops every now and again. But when you have the moments where you have an overlying thesis of the macro picture, that when things start to hit, that means that you can go on with the rest of your plan. Because if the
what vehicles did you use to take advantage of the downside? I'm curious.
I was not as probably exposed as because I was seeing some of that risk come up in January, and then mentioned it, in March in our interview and whatnot. And I had been preparing even myself in February. I'd seen how things were going on in the world, and I had adjusted things a bit and was, pre-buying food and all those kind of things, so that the shutdowns that, or self-isolations that have happened, did pan out, and I was happy with that kind of thing, and I thought Bitcoin, because the halving would have a nice bounce anyway, would recover with the market. And also my own general thesis of it being a 1987 style event, I put a lot of chips on that, and assumed that we would get the type of bounce that we've got, and we have. So now it comes down to, are we going to have the proper kind of human ingenuity that, you know, we're going to be focusing more on tech. Is tech going to be driving the markets to new all-time highs? I think that that's possible in the years to come, because
But tech's
there was
almost there.
yeah, exactly. So it could just pull the rest of the market higher, because, you know, when you look at, you know, Dow 30, right, it's the top 30 stocks. So if the top 30 stocks change, and those are, you know, we're finding ways to be ingenuitive as humans, then that's going to push the market higher. Yeah, so that was just something I wanted to recap, because that's something that we've been following for so many shows, and it's just like all panned out. So if this all keeps on panning out, then it could definitely, you know, there's going to be some kind of pullbacks along the way. That even happened with the 87 style dump in actual 1987, and the recovery afterwards. So it's not just straight up, but
We never had a retest of the low in 87 though, did we?
No, and that's not looking like what's going to happen here either. I really truly think that unless we have a really strong second wave of the virus, I think it went down too far and people priced in too much risk, right? So as things change in the future and we do get a second wave, we should be more prepared for it. So, you know, do we have to have that much panic and risk factored into the system for a second wave? I don't know. We'll see. So
do you think there will be? Any of your work point towards, you know, the parallel to the 1917 was second wave was, you know, first wave, then armistice, and people went out and forgot about it. And then the second wave was a devastating one.
Yeah, exactly. And that's very noticeable in the charts. And what really made the difference was how people acted in the summer and late summer and going into September. I think there's a chart that shows the difference between, I want to say it was St. Louis and Philadelphia. And one of the cities chose to have a parade for something that was going on, and one city didn't. And the, you know, the death, the impact.
It was Armistice Day.
Is that what it was?
Yeah, you know, celebrating the end of World War I.
Yeah, and yeah, very noticeable on the charts. So I think it's very important that people, you know, no matter what their personal views are of what's going on, that at least we be mindful throughout the summer and not just try and go back to completely as normal, because it doesn't mean stay at home all the time, but it does just mean, you know, when you're out and about, you keep that little bit of distance or whatever, and don't, if you've got a cough, don't go out kind of thing, because it's not like this crazy airborne tuberculosis kind of thing, right? But it is that if you're not paying attention and you're rubbing your face after you go out, you know, just like anything, you're going to get germs on you. So
what about attending a spin the bottle party sometime in the summer?
Yeah, I guess.
You remember that?
Yeah,
exactly. Play that? Huh?
Of course. In junior high, right? Yeah.
Why not now? I'm in my second childhood.
There we go.
All right.
Yeah. Blast through a couple charts here. Natural gas. This is something that we've followed or probably mentioned each time I've been on here. I've been kind of looking at this as it's like a general global macro indicator as well too, and it hasn't done anything crazy outside of, you know, what was projected over the last few months, where these pops downward are each about 15%, and if that were to happen from this low down 15 again, that takes us to the old channel. This pattern in here and here is all congruent. So if price can get down to the bottom of the channel again, and then it would be a strong buy. I think so the reason timing wise for people listening is that natural gas, you know, heating demand in the wintertime, you know, would drive price more than people just having barbecues in the summer. And so, you know, a push down here into the summertime with low demand and then a bounce back up, and that, you know, we're talking multiple years to get back up here again. But if we did have a push down and then just, you know, up here over the winter, you know, pull back next winter, that kind of thing, that could become very strong, long-term profitable trade for people. If it were to go kind of sideways, what I think that would show is that, you know, deep money, big players in the market would be putting strength in, like putting a base in so that it can pop up. Let's move on.
And big resistance at $2. Okay.
Yeah, exactly. Yeah. We usually end up talking about gold or something.
Yeah.
So we've had a huge, just, I don't know, U-shaped up the cup of a cup and handle if it were to ever happen. And the reason that I mentioned cup and handle is that last time I pointed out gold and Canadian dollars, same sort of shape. This in here reminds me a lot of what's happening here. If now we're going here, 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 here in an A, B, C, D type fashion. I think
Are we completing?
Yeah, and I think it completed right about here on the CAD side. So
yeah,
it could be cup and handle and up again, which could happen here too if we were to see, you know, here's our trade worries, and here's it getting sorted out. And then, you know, not all sorted out, but a lot of trade deals being done. This was like soybean and all that other stuff, the deals they actually did. And then we had a little pop up here for Iran, and it seemed like it was going to roll over. But then the coronavirus, boom, 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 here we are. So if we don't get a really bad second wave, and we still have these Chinese trade deals from before holding, you know, that would definitely seem like that this chart could then put in some of this sideways action. Maybe Trump wins again, and it seems like the market, even if it's Biden, it's like the market likes both of those options compared to a Warren or a Sanders. So that could create, you know, stability, and then boom, at the next election cycle, it could just take off. Or worst case scenario, you know, there is a bad second wave of coronavirus, and you know, all bets are off.
Let me ask you this: if their second wave should be in full gear around the elections, what do you think is going to happen?
Yeah,
are we going to have elections?
That's a tough one, right?
Is it going to be called fixed or rigged or
I think
hoax?
I think no matter what, it gets called fixed or rigged from either side, because if the second wave doesn't show its face till, you know, very close to the election, then you can't really even do paper ballots, or you'd have to postpone it. And I don't think if America's, you know, postponed an election, that would be a big deal. So and then vice versa, you go the other way and you know, you hold it. Or even right now, Trump was upset with mail-in ballots for the special election in California 25 last week, because, you know, a month ago he was saying, oh, you know, it's rigged, it's fixed, you can't have paper ballots. So I think no matter who loses, we'll just say that the election was fixed. Take a look at Bitcoin. We had it, this is on the hourly, run up and then break down into the global panic. So how I do my easy levels is I just take a look, what is retail looking at? They usually draw simple lines. Those create our RAID levels. As the panic happened, our first kind of stopping spot was here. Next, it came across there to that level. At the halving date, we finally hit our final RAID target. It rolled over, and that's clean break here. Huge volume after the halving sell-off. It came right back up to this area, which is, you know, congruent to all these kind of RAIDs. So that top also was the top here. We only spent a couple hours over top of that resistance after coming back to sweep all people's stop losses. And then yesterday's sell-off happened at pretty much the exact same level. And the price has come down to here last night. So I think that 9,800 is really the resistance people need to be looking at, more than the solid 10K moving forward. You know, people like to, I generally don't like to speculate on target prices, but, you know, you got to do every now and again. We've seen a huge run up on the first bubble of Bitcoin. We're talking like 50,000%. Here's 10,000. So we're looking at that as about 20%. Okay. So we got 10,000 here, and we got this. How I'm figuring these out is the top, the bottom, and then these circles here, here, and here are when Bitcoin halvings took place. So we had a speculative bubble, a pop, a bounce into halving, and in each three cases, this bounce was above this special red line that I have on my charts. So it's consolidating in what would be a bullish zone, which is good. And that from bottom to top here, 50,000. And then these here, here, and here, I'm starting my percent pull-ups at where halving took place. And each time it's diminishing returns, because as things get more speculative and more public, the percentage rise is going to be slower as, you know, just more people are in the market. So if we were to take that same sort of diminishing return, we're still coming up somewhere near 60 to 70,000. So if, you know, people want some hopium to latch onto for Bitcoin, you know, there's one way to take a look at the big picture.
Scott Henderson says, nice perspective on the back test relationship to halving.
Awesome, thank you. I think all of these charts we covered in my...
And someone was asking, what was the chart before the Bitcoin? Was that natural gas or that was gold? You went to gold.
That was, yes, that was gold. We were talking about the CAD USD or gold in US dollars and then comparing it to gold in Canadian dollars. Yeah.
Would you be buying, putting fresh money into gold here?
At this, I would be looking for a pullback or where are we here? Or a break, you know, like above 1800 and then, you know, like the first retrace. Yeah, here I'd be wanting to see a significant pullback just because we're so close to the ceiling. Yeah. Whenever we're really close to a bottom or really close to a top, I don't like to make a move until it just breaks one of those ways, because what's the point of, you know, 5%, you know, that you might be losing on either side of a trade versus just getting that solid confirmation.
Okay.
And I think we're almost out of time, but I did want to, where did I put it? There it is. So Livermore.
Question, do you have a view on silver before you get to Livermore?
Okay, yeah, so silver tends to always be like a lagger of gold in both directions. So
until recently.
Yeah, well, yeah, and then it does all its catching up.
If you don't have a view,
yeah, I mean, I think my general view on silver right now is that I think gold is doing this. You know, that's my view on gold. So if I think that this is going to kind of go sideways for a bit in here, and I would want to wait for, you know, gold to pull back to then to hit up silver. That's
what would make you bearish gold? Would it have to go all the way back down and negate that breakout on that horizontal line?
For me to get bearish on gold?
No, the previous chart back on, would it have to go under 1360 there?
Okay, this is on the Canadian one.
Well, they both had a break. Okay, that was 1760 in Canada.
In here,
and
yeah.
It was about 1360 in US. So if we fell to 17...
Oh, I see what you're saying here, yeah.
Yeah, that's a breakout. If we ever took out that breakout, would that change the picture in gold and tell you that we have, you know, really a big liquidity crisis happening? Or
for sure. I mean, if we saw a breakout above and then it come back and back test it, and then the next couple daily candles, you know, base, then that's definitely a sign of something huge happening in the market. Yeah.
Okay. All right. I'm pretty bearish up here.
Yeah.
Anyway,
okay. Yeah. No, and I get it, because we're right at the ceiling, right at resistance.
Yeah.
Yeah.
All
of
right.
course.
So what, you have a Livermore chart?
Yeah. Very quick.
Okay.
Sure, yeah. So, you know, a lot of people talk about Jesse Livermore because he made and lost so much money, and he really is a great. I'm writing like an ebook on him and trying to turn a lot of his quotes into actual charts, because that's the thing about Livermore is he was a tape reader, and he was, you know, a pioneer in his day, and he didn't leave behind like a treasure trove of charts. You know what I mean? And it's a lot of
who else is a big Livermore fan? You ought to have a discussion with Don Mead. You know Don?
Okay. No, I'm going to write that down, though.
Don Mead at 7 Sentinels. He's another Livermore guy.
Okay, awesome.
And he's a lot older than you, so he's
Probably
had more
about
time to study him. So
Yeah.
anyway, okay, go ahead.
Yeah, so you know, made and lost a fortune multiple times because you know, he just didn't book the profits and hold on to them, and lifestyle and all those kind of things. So this is probably the most famous of Livermore action, was the just this disgusting amount of money he made in this crash. Now, here's the thing: he lost almost all of his fortune that he made there by going long here and it dumping on him, going short here and it rising, and then going long again here and it breaking down. Whereas if he himself would have followed his own rules, so that there's two basic rules. There's the Livermore chart that everyone sees, that's a speculative chart, speculative bubble. And then there is like here and here. What he was a breakout trader. He wanted to see a strong macro environment. So, you know, globally things are going good. In America, things are going good and the market is trending up. And if the market is trending up, he wants to look at the strongest sectors. And then within the strongest sectors, he wants to look at the strongest markets. He doesn't want to look at laggers because they're lagging for a reason, was his thing. So when everything in the macro is on your side and everything is pushing, he would be buying breakouts or shorting, you know, new lows. So
he's adding on the way up.
Exactly. So we're going to look at
go ahead.
Yeah. So a couple of, you know, ways to see that. We'll use like a couple ways to see that in our times is, you know, gold here. We had, you know, resistance and a breakout. He takes more position. You know, more that backfills, but it holds. Resistance, breakout, backfills a bit, and on the way up. A little bit of a resistance, breakout, backfills a bit, on the way up. And he just keeps on adding and adding and adding. And then when things starts to break down or go too so much sideways, he's also looking at volume. And then, you know, he's either probably exiting here, or on a breakdown here. Because he was all about panic, he made lots of money in the panic on the way down too. You know, if we were to look at our
but he was early bottom picking. And then he was just so out of rhythm after that.
Yeah. And then if we look, see if we see one of our last crisis, 07 through 09, you know, we had a breakdown to this low, which is equal to here, a little bounce off it. And then as it comes back, this breakdown, which he would have short, that would be what he calls a pivotal point. It would have been happening here, and probably some chop up here, but he still would have got in another position. So this is things that people can see. And then this is an example of this actual parabola chart. He did not like sideways, even though Wyckoff, you know, we know from our Wyckoff models that sideways can be good. He didn't want to touch that. He wanted to see the strong macro and then a breakout, you know. So we have the sideways, we have a breakout, he takes a position, it backfills. And then we actually have the cylinder, and then the breakout here, right? Cylinder, a breakout, back test, and go. So I think that these are just, you know, for people that want to dabble in crypto, especially altcoins. I talk about Livermore a lot because altcoins are very parabolic and quick. You can be playing those on like the 4-hour chart, or if people are more long-term investors, you know, this is the whole, my, you know, trading didn't make me my money. It was my sitting and waiting that kind of did quote, right? So those are just ways that, you know, people can get really lost in the, and just in the chaos sometimes, right? But when you just sit back and take a simple view of, if things are moving up, I'm going to go with it. If things are moving down, then go with it. But if things are just going sideways and chopping up and all whatever, then you don't have to trade every day, and keep that money for yourself. You have to make back your losses. So don't be going off all happy shooter every day just because you got to get a trade in and use the trend, you know. So
make yourself rich, not your broker.
Exactly.
All right. So anyway, you did it again, Matt. Another great interview.
Well, thank you.
Yeah, enough pearls to string a necklace, and appreciate you being here again, my trading warrior brother. How do our viewers keep in touch with you?
Yeah, so you can go to my Twitter page, which is djthistle01, or coinstreetnews.com. The blog is active. We do mostly focus on cryptocurrency trading. because of the volatility, and bag your profits faster. But I do also cover some commodities, natural gas, and I like to, even though I don't post a lot of stocks, we do follow the general global macro picture because, again, due to Jesse here, Bitcoin is still part of the global macro picture.
Okay, well, Matt, I hope that you remain untouched and all the people you care about untouched by this COVID, and that really was great having you. Let's get in touch after the interview and get you scheduled for August and see what's happening there with natural gas.
Ghost month, perfect. Okay.
Huh? Okay. Oh yeah, that's right. Yeah, I learned that from you.
Yeah.
Ghost month. So I'll be wearing a sheet and I'll turn on the webcam for that interview, buddy. So everyone, you're getting great, really great. Thanks. Nice show. Thank you,
everybody. Okay, awesome. Have a great day.
Everyone, my trading warrior brother, Matt Thistle. Have a good day, everyone, and we'll see you wrap it up on TGIF. Don't just count your Bitcoins, your halves, your gold coins. Count your blessings, and we'll see everyone tomorrow. Adios.